And for an early look at what we can expect from the local market, we're joined now by Chris Weston from IAG in Melbourne. Chris, good to see you there this morning. Look, one of the big stories, of course, the Nasdaq glitch, but that didn't seem to really affect trade.
No, that's right. I mean, we saw obviously the Nasdaq. You couldn't trade over the Nasdaq, and there's a lot of people talking about the damage it's going to do to confidence. The fact that Nasdaq was down for just over 3 hours. I think probably the biggest story here is just the amount of exchanges you can trade over the US and the alternative exchanges, and perhaps the room for consolidation which may materialise. But the S&P had a very good strong gain last night, as you heard in the synopsis there. All sectors doing quite nicely. But again, it's down to European data. European data, as UK data as at the moment, is doing very nicely. We're seeing a good expansion now in the PMI series, not just in manufacturing but in services. That's on the composite numbers, but more importantly, Germany, which makes up obviously the large bulk of that, has gone from around 43 back in July 2012 to around 52 now, back above that boom bust level. So really the European, or the euro, is becoming somewhat of a sort of quasi safe haven given the flows we're seeing there at the moment. The same as sterling, and I think the positive there is that about 70% of UK gilts, which have been under heavy selling pressure in line with the US Treasuries, are held by domestic institutions. So if people are looking to sell out of the bond market, they don't necessarily have to send those funds offshore. But yeah, certainly the data that we saw in Europe, as you say there with the China data, which shows now is that the real big positive there is that the HSBC series, which obviously measures about 420 of the smaller businesses, the ones that have been more heavily affected by the lack of credit or the lower credit that's been going into the economy, is now in expansionary territory along with the official numbers now. So we've got the large businesses and the small businesses back in expansionary territory. It shows the measures by authorities in China in late June seem to be picking up traction, which is great to see. We've had our China hard landing moment. It's now time to again reflect more heavily on Indonesia and India. But yeah, I think today we're going to get off to a bright start here in Australia, and we're looking for the market to open just above that 5100 level, so a good gain on open. Hopefully if we can push above 5113, we'll be in positive territory for the week.
Now, Chris, we've been seeing some buying action in emerging market currencies overnight, and we have been hearing this morning some big declines in the reserves with the central banks. How much of a concern is that for you?
Well, the reserves is testament to what the central banks are obviously trying to do in developing countries, emerging countries. They're obviously looking to try and stem the bleeding and try and support their currency by using some of their absolutely huge levels of FX reserves. What the article in the FT has suggested, something like the 81 billion US dollars has been used in terms of their FX reserves to try and curb the dramatic falls we've been seeing. It's only about 2% of all emerging market currency reserves. So there's still a huge amount of ammunition left. But I think it really goes to show just exactly what they're doing. Now, overnight we did see good buying in the Mexican peso, the Brazilian real and the South African rand. So that's obviously a good positive for us. We need to see those emerging market currencies stabilise to a degree. But it's really going to be about Indonesia and India when they come online later. They don't have 24-hour markets in the FX markets. I think India open at 1:30, Indonesia are about 11, and they've been really doing it very, very tough because they're very high current account deficits. Now, if you run high current account deficits, you need external capital to fund that. Now, obviously, markets, a lot of that capital has been fleeing these different areas. What does it mean longer term? The negative consequence there is, if you are seeing fleeing capital, is you have to do something about your deficit. Now, global funding conditions either come down or you have to come out with some stringent austerity, and I think the latter is really what we're going to be seeing in those countries. Of course, stringent austerity means you're going to see lower growth, and I think that's the big concern in these places at the moment.
Absolutely, and we have seen also, Chris, the Indian rupee also plunging to lows against the US dollar. We do have to leave it there for this morning, Chris. Thank you.
Okay, cheers.